Hi folks, this is Craig, the options linebacker. This is the weekend report for Sunday, July 11th. Now the theme of this week's video is the market isn't what you think it should be. So let's take a quick look and see what's going on in the world. We have a huge oil spill that seems to have no end in sight. We have economic numbers dropping like a stone, like the Baltic Dry Index, the weekly leading growth index, and we got your typical political unrest out there. In short, there's no good news out there unless you live in Miami. So why did the market rally last week? It doesn't make sense, does it? We have the S&P 500 in a bearish megaphone pattern. We have the S&P 500 weekly chart in a bearish head and shoulders pattern that broke the neckline last week. We're in a primary downtrend in all the index charts. It just doesn't make any sense. Why didn't the market just keep going lower? Well, if you're looking for an answer, here it is. The herd is almost always wrong. As soon as you get everybody thinking the same thing, and a week or so ago, this is the case, is that everything seemed to be heading lower. We had broken that head and shoulders neckline pattern. Everything looked to be extremely bearish with a pattern bottom probably around S&P 870 is where most people were calling for it. Well, as soon as you get everybody agreeing that everybody else is right on that, then you get the herd, and the herd is almost always wrong. Now, just to give some perspective here, I'm a firm believer in chart patterns, but these days it seems like everybody is an expert on chart patterns. And when you have somebody on CNBC, calling from the top of the hill about a chart pattern and how it should unfold, chances are pretty good that that play is then over. You can see here on an S&P 500 chart, going back a long time, this goes back really to the 30s here, is that we've seen these megaphone patterns before. Now this is a log scale, so unless you have a log scale on your chart, you're not going to see it. But here's a perfect megaphone that occurred back in the 60s and 70s. And look how this unfolded over time. Sure, this was a textbook megaphone pattern, but it broke to the upside. So here we have the same thing going on right now. We have a textbook megaphone pattern that's played out over the last 10 years and should by all rights probably break to the downside according to megaphone pattern theory. But we really have a precedent that it has to break to the downside? No. If you were trading last summer, everybody on the planet saw this beautiful head and shoulders pattern on just about every index that was out there. Break the neckline as we got into early July, almost exactly a year ago. And then when earnings started, hello, I guess earnings weren't so bad after all, were they? So here's another example where when everybody sees the same play, usually that play is over. Okay, so let's get into today's charts. Where is this thing going? All right, we've had a 5-wave series off the bottom beginning in March of 2009. This is a classic 5-wave impulse motive series to the top side. Beautifully formed, looks great. Normally what we'd see after that is we're either going to see an ABC correction, which I can make the case that we've already seen ABC, and it's come down to a 38% retracement of this entire rally. Now this is potentially the best case scenario for the beginning of a new wave to the upside. So what we'd see from this is we'd see some fractal waves here, so this would be a daily wave. We're not going to get our first daily wave, get above 1130 on the first try. So what's going to happen is this will turn into a lower high, and then that will encourage more bears to start shorting this thing, thinking that, okay, here we go again. But then at some point, a longer term time frame bulls will step in here and turn this into a first wave to the upside on the weekly chart. So this is the potential most bullish outcome from here. Now on the flip side, what we might find is that this move isn't done yet, and the next stops are going to be either at 950 or perhaps as far as 870. Actually, these are still valid ABC corrections in the terms of this longer term bull here. Realistically, you can say that this is just a textbook correction to a bull market if it goes down to a 50% or 61.8% fib, but you and I aren't going to feel like that. This is going to feel like a full-fledged bear market, and it's going to be several months long. Actually, most bear markets last about 18 months long. So at the very least, if we go down to a 50% or 61.8, it's going to be undistinguishable from a regular bear market, because this is going to feel like wave 3 to the downside. And so any bounce up will probably have to double bottom before it does reverse. So this is going to turn into, at the very least, a mini bear or a cub market if it falls below current support around S&P 1010. You can kind of see that this inflection point that we have right around now, and in fact should print within the next couple of weeks, is going to be really, really important, because it's going to make the difference as to whether we jump into a new bullish impulse wave to the upside, or whether we say that we're just not done correcting yet and it turns this corrective move into a much deeper one. So how do we figure out which is going to happen? Well, let's go down to the daily chart and examine that in a little bit more detail. And we can see that this wave here that went from around S&P 1130 down to about S&P 1010, this wave has got some retracements here, 38, 50, and 61.8. We would expect that this rally would probably top out roughly around the 61.8, perhaps even fill the gap that's up at this level here. So that's about 15 points higher from current prices. Now that's the S&P pit gap, not necessarily the cash gap here. So those are certainly a couple of targets. We may drift up higher to meet those, we might not. It really doesn't matter that much. What really matters is that we will have a reaction off of this high that comes back down. Now, that's the big important thing. That really sets the inflection point, almost really for the rest of the year, will occur in the next couple of weeks here. Okay? After this starts coming down, will it find support there and create a higher low and allow this to punch through this descending trend line, which is setting up right here? Okay? So that's possibility number one, and as we talked about, that would be that first weekly wave to the upside. So that's going to be a fairly powerful wave if it's able to get through there. And almost certainly it's going to be punching through there based on earnings surprises to the upside. Really, the market, the number one market mover is earnings, and it always has been, always will be. And much like last summer, where the earnings reports were sort of, nobody expected a whole lot, and there were upside surprises, as we showed you, by that head and shoulders pattern being violated to the upside. Same thing is kind of in this series. Nobody is really expecting a whole lot. The sentiment is extremely poor right now, so this could certainly create quite an upside squeeze. Remember, as we talked about in the first few slides of this presentation, the sentiment is really bad right now. Nobody's expecting much. Everybody's very, very gloomy. So this would be a maximum surprise to see anything squeezed to the upside past this trend line. Now, if earnings reports are even worse than we expected, then what we'll see is, at the very least, we'll see a double bottom down here at S&P 1010. So in that case, what we'll have to watch for very carefully is to see whether it actually double bottoms and perhaps starts its leg higher based on that, or if it loses that support. If it loses that support, then you're going to see a very quick trip between S&P 1007 and around S&P 942. So next week, here's where all the action is, right in here. When this happens, when we do finally start to drift down and create that potential higher low, what happens will set the tone for the rest of the year. Now, just a brief word on positions. We've already out of our July positions for the month. We took early profits on those. We saw the volatility coming up. Didn't want anything to do with it. We currently have our August positions up here at Spider 117 and down here at Spider 92. So you can see that the price is almost near the center of the iron condor. We have more room to the downside than the upside. That is perfect position with about 6 weeks left to trade. So have a great weekend, folks. We'll see you next week.